Hello and welcome to Pensions in 10 with me, David Brooks, and my colleague Andy Knight-Stevens. This week, we take a look at the Trump tariffs and also the new regulatory focus on professional trustees. Okay, Andy, a week or so ago, I said I was glad to have an actuary with me, which made some people raise their eyebrows. But this week, I'm very pleased to have an investment person with me to explain what the Trump tariffs are all about and the impact on markets. So over to you to give us the lowdown.
Thanks, Dave. Yes, so it's been a quiet week over the last week, Dave. Donald Trump has been in office just 3 months. So what we're talking about here is Liberation Day, so-called Liberation Day, the 2nd of April, and the US administration, President Trump, has announced a raft of increased tariffs on US trading partners. I suppose what has surprised some is that he's actually gone and done what he said he would. The other comment to make there is perhaps the tariff rates and what was announced is higher than I guess many market participants were expecting. So whether that or the moves were fully priced in to the markets, it appears not, given what's happened in markets, and we'll talk about that in a minute. But yes, it's a politician who's gone and done what he said he would want to do. So that's interesting. So yeah, in summary, over the last week, the only thing that's happened is an attempt by the US to completely overhaul the world trading system. So, an imposition of significant new tariffs were made on US trading partners, and that has initiated a wave of disruption on global trade and financial markets. I'm not going to get into the particulars of each tariff on each country. People have probably seen that board that was held up, maybe not watched the video, but seen that held up. But it's going to impact various sectors, various countries, and there'll be different winners, different losers, perhaps at the moment, mostly losers for everybody. But what it means is there's a lot of impact for UK institutional clients, but also in the DC space, but also the wider global economy. So let's just dig into a few asset classes and what it could mean. So in terms of gilts, let's go with gilts first, which affect UK pension schemes. So looking at just the 15-year gilt yield. So since the announcements, gilt yields have reduced a little bit. I wouldn't say a massive amount. So, for example, that 15-year gilt yield, if you look at the start of 2024, that was around 4.0%. So before these announcements, it was about 5.1%, coming down to around, after the announcements, 4.8%. So gilt yields have reduced, long-term gilt yields, but not by such an amount to take you back to the start of 2024 levels. So they reduced a bit. So obviously that means falling gilt yields increase your liabilities, but the impact on a UK pension scheme will depend on the hedge ratios and specific circumstances of that client. Credit spreads, so credit spreads have moved out a bit. They've increased, so that could reduce the value of your credit corporate bond holdings. The impact on there will depend on the type of credit you're holding, the duration of that credit holding. But credit's slightly different. So assuming many clients and schemes are holding or trying to hold the corporate bonds to maturity. So obviously, look, you get short-term fluctuations due to credit spreads changing, but as long as the bonds are money good and you're holding them to maturity, maybe that's less important. If you're still going to get your income, that's good, but they can also contribute to your hedging as well. Equities are where the biggest impact has been seen. So, when I say this, Dave, and it goes out, the numbers will have changed and I'll be out of date already. But if you look at US markets, certainly this morning in European markets and what's happened, overnight in Japan and Asian markets, certainly over 10%, some of them 15% down. So significant hit to equity markets. Again, speaking to perhaps that people didn't think that the tariffs would be of this size. So for a UK pension scheme that's got significant oil growth allocation, including equities, the funding level would have taken a hit, all things equal. That's obvious. But again, the impact will depend on size of growth holdings there for a pension scheme, how far you are away to your objective, and what your objective is. So look, strategically, we still like equities. They are a long-term asset class, so you do get volatility. This is well known. Whether certain trading partners negotiate with the US and some of these tariffs come down, we don't know. Whether there's retaliation and tariffs increase or things get worse, we don't know. But equity markets are certainly down, and that bears thinking about for UK pension schemes clients. Currency, so we've seen some fluctuation. Let's take USD v GBP. It's moved, but then it's moved back a bit, and I would say it's within the sort of areas we typically see for the FX rate between those two countries. So I say it moved a bit, but it's not a big deal. But obviously, it's another consideration. Do you have any unhedged assets in your investment strategy? But overall, I think what are we going to say for potential actions for trustees and clients of UK pension schemes? I think it's don't panic, Dave. Look, people are still understanding what's happening, what's happened, and the impacts. It's fast moving. Certainly, today equity markets are falling further. But don't panic. Take a step back. Whether clients need to rebalance their portfolio due to these movements, that's one thing that could be looked at. As I said, review any currency exposure, but I don't think the moves have been as material there yet, but that could change over time. Certainly reviewing liability hedging and waterfall, these are normal things to do. And I think, obviously, part of the course, clients and consultants will review investment strategy over time, and that should carry on happening. Whether what's happening here makes a fundamental change to the world order and what it means for risk assets and investment strategy, that can be picked up by a consultant in the next strategy review, and consultants will be in touch to help you understand the impacts. But for now, significant market volatility and sizable changes and impact on growth. Okay, Dave. So this item is the pensions regulator has announced that it will extend its oversight to include professional trustee firms. Okay, so I guess over to you, Dave, for any thoughts you've got on this.
Yeah, no, announced on the same day as Trump's tariffs, so maybe it got a bit buried in the news. So we'll give a little bit of light here. So Nautica Delfast talking at the Trade Union Congress Pensions Conference, and there's something that was trailed by David Walmsley at the PASA conference a couple of weeks ago. So we knew something was coming around the regulation of trustee firms. So the regulator points out that the trustee firms, around 10 of them, advise probably up to £1 trillion, I think it is. Yeah, more than £1 trillion of savers' retirement income. And so as they move to a prudential regulator, that does feel like a potential for a systemic risk. If trustee firms aren't operating in the way that the regulator and others might think, then that could be an issue for decision making, and that will obviously have a knock on then for saver outcomes, and that's obviously the big thing from the regulator's point of view. So they're going to be looking at relationship with employers, remuneration models, sole trusteeship, and how relationships with in-house advisors works, and that's kind of in-house advisors at the trustee firm, and then how the scheme decision maker goes about making decisions. So they've been broadly welcomed by the trustee firms, as you would expect, because that oversight should be welcomed. There are some question marks around how the regulator is going to do this, because this isn't one of their formal regulatory areas. They don't have the formal power to do to give guidance in this area necessarily. They've got a very big stick. That is basically, if they think a trustee isn't operating appropriately, they can replace them. So that's a very big stick they have. However, they don't really want to use that as their sort of only method of regulating the sector. That's not really going to be very constructive. So I suspect they'll work towards creating guidance, and that'll be guidance for employers looking to appoint, trustees. Is often an employer that will look to appoint a corporate trustee, a professional trustee to a board. But then also, obviously, lay trustees may also look to do this if they want some professionalism. If they're going through a particular exercise. Risk transfer is a common area where professional trustees get involved. So we'd like to see some guidance coming on those areas. And I suspect when this data gathering that will be done over the next few months and possibly over a year around that time, that if the regulator feels like they need more powers in this space, if there are some systemic risks that they're concerned about, then they may need to go to the government to get those powers introduced. And that's the sort of thing that happens behind closed doors at the Houses Houses of Parliament and House of Commons that we don't get to see, obviously. So definitely very interesting. We knew it was coming, a bit like the tariffs again. The impact probably going to be less dramatic than the tariffs, but yes, notable as another step from the regulator towards this prudential style of regulation.
Thank you all for joining and listening and watching. We'll be back on, or Dave will be back on next week. In the meantime, let's keep watching the markets. Goodbye.